Hi, I'm Steve LaFrance with Financial, and I'm presenting our monthly recap in 3 minutes. 2023 is off to a great start with the S&P up 6.3%, small caps up 9.8%, corporate bonds up 5.2%, international up 9.0%, and emerging markets up 9.1%. All of this came on the heels of Q4 GDP growth of 2.9%, a continued downtrend for inflation, and expectations of smaller rate increases by the Fed. Our pace of GDP growth has slowed, but signals will return to a more normal pace. Yet economists are concerned that higher rates may lead to spending cuts and job losses and tipping the U.S. into a recession. As I've said before, who really knows? But that's the current vibe, so let's explore some key themes we may see in 23. Inflation could fall more than the Fed expects, with many of the factors contributing to higher inflation last year now reversing. Goods are already falling and supply chain improvements suggest more declines ahead. Services will also likely come down as pent-up demand from the pandemic fades and wage growth normalizes in a cooling labor market. Unemployment only has one way to go, up. Let's face it, we've been hovering around historically low numbers for a while now, with reports of 2 job openings for every job seeker, and the Fed has made it clear they will remain aggressive until they see a weaker labor market. This chart shows they're expecting to see a 1 percentage point rise in the unemployment rate, which keeps us in a normal range. Attractive bond yields are already driving fixed income returns. Historical data suggests this year's total return profile is at its most attractive since 2008. And as they say, past performance does not guarantee future returns, but this relationship between annual returns and starting yields suggests a total return of nearly 6%, which may be further boosted if an investor flight to safety occurs. This is exactly the kind of diversification we hope for in most of our portfolios. The jump in mortgage rates has weighed on the demand for housing, and there are concerns that home prices may experience a deep downturn reminiscent of '08. But housing market fundamentals are very different now, so we see this as overblown. Supply remains near a decade's low level due to underbuilding during the pandemic, and deleveraging since '08 should prevent any significant forced selling. This tight supply environment should help keep home price declines contained this year. The China reopening will be a mixed bag. Their sharp reversal on zero COVID policies will boost domestic mobility, lifting energy demand and supporting higher oil prices. On the other hand, their economy will stabilize, further supporting supply chain and business growth. Higher inflationary pressure is not expected since their approach to government stimulus was limited. So those are just some forecasting highlights. Our outlook for 23 continues to hinge on whether the Fed can rein in inflation while keeping us out of a recession. But because the labor market continues to show strength, lending support to the consumer sector, the largest part of our economy, we are cautiously optimistic that the economy and markets will move in a positive direction this year, though there may be some bumps along the way. As always, appreciate your trust and confidence to help you navigate these uncertainties.